Yo, what is going on, guys? My name is Family Shucks and welcome back to another video. So in today's episode, I'm going to be telling you guys about two dividend stocks that I decided to buy for my Roth IRA that I finally pulled the trigger on because I thought they were at a very attractive price point. Now, I want everyone to know that I am not a financial advisor or anything of that sort, so my stock choices are not the cup of tea for everyone, but personally for me, I think they are well suited for my needs. Not only am I going to be giving you guys a breakdown of the stocks I decided to buy, but I'll be looking more in depth at their business segments, their financial health, and also my personal insight on their future prospects on where each of these companies have in the near future. So with that being said, let's just cut all the talk and let's just get right to it. So as you can see right from the beginning and right from the get-go, we got both of the companies that I am going to be talking about for today right on the screen right here. And I decided to cook up a little bit of a dividend cheat sheet for you guys utilizing Seeking Alpha, and that is the website that I use specifically for looking at dividends and dividend payouts and all that stuff in regards to certain stocks that I am looking more in depth into, because I feel like the Seeking Alpha platform does a really nice job of showing a really nice dividend scorecard for each of the stocks I am looking at, and then you can look more in depth at the dividend growth, the dividend history, etc. But for the time being, the dividend cheat sheet that we have pulled up right here, the first stock that we're going to be talking about is AT&T with its ticker symbol T, and the second one is going to be called Realty Income Corp with its ticker symbol O. Now, I give a little bit of a breakdown comparing the two, and we can just run through it real quick, but first things first, AT&T has a dividend yield of 6.88%, payout ratio of 65.08%, dividend growth for a nice stable increase over the course of 36 years, which is really crucial, especially when I'm looking at dividend companies, is I want stable incremental growth for their dividends every single year, and AT&T has been a company that has been doing it for the past 36 years, hence why it is a blue chip company that has been called a dividend aristocrat. So it really does live up to its name. A little bit more information about AT&T is that it has a quarterly payout frequency with the amount of 52 cents per share every single quarter, and it has an annual payout of $2.08 per share at the end of the year. Now, the next company that we're going to be looking at is Realty Income Corp, which is a REIT, which stands for Real Estate Investment Trust. And its dividend scorecard is fairly similar to AT&T. It has a dividend yield of 4.78%. Payout ratio is very high, almost 85%. And the reason that's because REITs are actually required to pay at least 90% of their taxable income to shareholders annually, hence why Realty Income Corp's payout ratio is so high. And similar to like AT&T, its dividend growth has been growing for a stable 26 years, which is something that I really want to encourage, is that when you are looking for dividends for specific stocks, make sure that its dividend growth has been historically growing over a long period of time, just so that way you know and have some reassurance at least, because even though you don't know the future, you at least know from the previous histories and from its previous past that it has been growing at a stable rate every single year for a long period of time. Now, unlike AT&T, Realty Income Corp actually has a dividend payout frequency of monthly. So every single month you are receiving a dividend, which is crazy, especially if you load up on a bunch of shares. You're going to be having a steady flow of dividend and passive income every single month. Now, the amount per share that you're going to be getting is about 2 cents per share. However, the annual payout comes out a little bit ahead of AT&T at $2.80 per share. And let me reiterate again that these two stocks are actually going into my Roth IRA. Now, my reasoning behind this versus putting these two stocks specifically into, say, a brokerage account is because I really want to focus on dividend growth with these two stocks in order to help grow my portfolio. And the thing that you should know is that dividends also get taxed, so I want the dividends that I receive from these two stocks to grow tax-free in my Roth IRA. But now that we've had a quick summary of what two companies we're going to be looking at for today's episode, let's just go a little bit deeper into each of these two companies and take a look at their business aspects, their financial health, and also my personal views on their future prospects. So the first company that we're going to be looking at is AT&T. Everyone can find it on the New York Stock Exchange with the ticker symbol T, and its current price range at the time of recording this has been hovering around $30.25. Now, it has been fluctuating a lot in the past couple months, as with every single stock going on right now, but its 52-week range has been $26.08 all the way up to $39.70, with a PE trailing 12 months of 15.36, which isn't too bad, and also has an earnings per share of 1.97. Now, my personal opinion, after doing a bunch of research and all that stuff, especially looking at the price history of AT&T and how its stocks fluctuated over its entire lifespan, I would say the low 30s to high 20s is a very solid entry point for AT&T if you are looking to buy. And continuing on with its profile, we got total assets adding up to $545 billion and liabilities equaling $350 billion, with a current ratio of 0.75. But let's look a little bit more into AT&T's business segments. So within the United States and also globally, it reaches out to about 170 million customers, and AT&T has four main business segments within its company. The first one being communications, which makes about 84% of its revenue, and that includes wireless, wireline telecom, video broadband services, all that kind of stuff that you know AT&T to do, especially with cell phones and 5G and all that. That is a main source of AT&T's revenue. Another business segment that it has is Warner Media, and actually recently in 2018, AT&T acquired Warner Brothers for around $81 to $85 billion, and adding on to the legal troubles that they had, they finally settled for Warner Brothers for about $100 billion, which is crazy. So Warner Media makes up about 11% of AT&T's revenue, and obviously that segment mainly prioritizes media, entertainment, and content. So we have brands like Turner, which involves TNT, TBS, Adult Swim, Cartoon Network, and CNN, and also within Warner Media there's HBO, and recently they launched the HBO Max. And lastly, of course, there is Warner Brothers underneath Warner Media. And as a part of AT&T's global outreach, they do have a presence in Latin America, making up about 4% of its revenue. And this basically encapsulates both of the two segments from the prior, the communications and also the Warner Media, where they provide entertainment and also services, things like AT&T, DirecTV, Sky, and Unifon for their customers down in Latin America. And the last business segment of AT&T is something called Xandr, which I personally never knew about until I looked more in depth into this company, and that makes about 1% of its revenue, and this is mainly focusing on digital advertising and using a bunch of customer data. But obviously the important thing about buying a company and holding it for the long term is that you want to understand their financial health. But looking at Q1 of 2020, it reported a revenue of around $42.8 billion, which is less than what it reported for Q1 of 2019 by about 4.6%, which is a large drop, especially after the Q4 2019 revenue reportings of $46.8 billion. So unfortunately they weren't able to continue on that high stream of revenue into the first quarter of 2020. Moving on from that, looking at their earnings per share, they did have a nice growth of 0.64 for their 2020 Q1 earnings per share, which is a huge up from their 2019 Q4 earnings per share of 0.33. Overall, I would say that AT&T has a very wishy-washy financial health in terms of sometimes it goes up, sometimes it goes down. And I think that's very reflective of its price, where it's very stable and doesn't really grow that much over the course of a long period of time. However, like I said before, the main focus of this is to build my dividend portfolio. Hence why I think AT&T is a very strong pick, just because of its long dividend growth and history. Now, continue on looking at its company financials. The two main things I want to look at is the dividends, which can be found at the second to last arrow, and you can just see that over the years it has been growing steadily every single year, which is something that I really want to see, especially if I'm picking a dividend company. And the next thing I want to look at is its income statement analysis, particularly looking at its revenue, where you can see right here again that everything is growing year after year. And obviously there are going to be some flaws with AT&T. AT&T doesn't really have the best balance sheet, as I said before. You can see its tangible book value at the top going negative, which is not something that I really want to see. And also, if you're in the investment space, that you know that AT&T carries a lot of debt, a hella amount of debt, and it's going to take a long period of time for that debt to get paid off. And because of that, a lot of people who look at AT&T are very turned off by it just because of the large amount of debt, which many people feel holds them back. Now, what are my personal feelings towards the future of AT&T? Now, recently, like I mentioned before, in 2018, AT&T acquired Time Warner after a large payment battle with the law system, and I feel like Time Warner acquisition really strengthens their media segment, which, especially during a time like now where a lot of things like Disney Plus, Netflix, and a lot of content creation is really starting to take off, especially because people want to see content in their homes as a form of entertainment, especially during these times where no one can really go out. A lot of companies are really trying to take advantage of this, and I think that AT&T positioned themselves well to be able to take advantage of that and to escalate their content platforms. But like I mentioned before as well, AT&T has a lot of debt and it's forever growing. I think right now it is around $152 billion in debt. So hopefully they will be able to pay this down one way or another, just so that way they can kind of grow other portions of their business. And finally, similarly to their Time Warner positioning, I feel like they have very strong positioning in terms of their 5G and also related to Time Warner, their premium content. So 5G, as we know, AT&T is a very large provider for telecom services, and as more 5G cities are starting to pop up, I feel like because of their global outreach and domestic outreach, AT&T has a very strong positioning in order to take advantage of 5G, especially amongst the other competitors such as Verizon, Sprint, and T-Mobile. But that about wraps it up for the profile, the quick profile for AT&T. And that means let's just jump right into the next one, which is Realty Income Corp, with its ticker symbol on the New York Stock Exchange of O. And it is currently priced at $58.59 with a 52-week range of $38 all the way up to $84.92 with a PE trailing 12 months of 40.27. Now, personally for me, 40.27 is a very high PE. However, I will be talking a little bit why I recently decided to buy into Realty Income Corp at its current price point, which actually is this previous Friday of me recording this, and my kind of thought process and logic of why I decided to finally pull the trigger on Realty Income Corp. But moving on from that, it has an earnings per share of 1.46, which is still pretty decent. Its total assets are looking at 18 billion, total liabilities looking at 9 billion, and a current ratio of 2.00, which is something that I really like to see, especially with a company. Maybe not at this price point, but just overall, a company with a current ratio with 2.00 means that it has a very strong balance sheet in order to weather, or hopefully weather, any type of storm such as this one. So what are the business segments that Realty Income Corp is currently involved in? Realty Income Corp is a REIT for specifically single tenant properties. So some of these tenants actually have something called a triple net lease, which is something that means that the tenant promises to pay all of the expenses on the property, including the real estate taxes, building insurance, maintenance, and all that sort of jazz, all while companies like Realty Income Corp just collect their fees. But what is the scope of Realty Income Corp? It has 265 commercial tenants across 49 different industries. 82% of their properties are in the retail space, 12% are in the industrial, 4% are in offices, and 2% are in agricultural. And one main thing is that, especially with REITs, that you really want to have good tenants. And personally for me, looking at the tenant list, or at least their top tenant list for Realty Income Corp, they have very strong tenants within their properties. Companies like Walgreens, 7-Eleven, FedEx, Dollar General, LA Fitness, Walmart, AMC Theaters, and Regal Theaters are companies that you really like to see within these properties, because you know that these businesses, maybe besides AMC Theaters and maybe Regal Theaters, are stable businesses. Aside from those two companies, you can see that those other companies in their top tenant lists are very strong, because you've never not seen them, and they're always in business, always have customers, and I don't imagine they really have that big of an issue paying off their rent to Realty Income Corp. So overall, their tenant list is very strong, and I feel like their niche in single tenant properties is a very big strong suit for this company. Overall, Realty Income Corp's financial health is looking very strong. The revenue seems to be continually growing year after year and quarter after quarter, reporting a Q1 2020 revenue of $414 million, which is a really great thing to see, especially during these economic situations. But as everyone knows, Q1 of 2020 doesn't really encapsulate the full effect of COVID. So that is something that I'll really be interested in seeing when their Q2 earnings come out in August, is how badly their revenue and other financial aspects of this company have been affected by a full quarter of COVID. But nonetheless, this is something that I really like to see, is growing revenue year after year and quarter after quarter. What else does this company's financials look like? And overall, it looks pretty good. Tangible book value is going up every single year. Same thing with its earnings. A very important part, obviously, with this company is that its dividends are increasing every single year, as it has for the past 26 years. FFO, as I highlighted in here in the top portion, as well as the income statement analysis. FFO stands for funds from operations. Looking at the definition from Investopedia, it says FFO refers to the figure used by real estate investment trusts to define the cash flow from their operations. And as you can see from the bottom, its balance sheet is pretty high. You can see that in 2019, their cash on hand loaded up to about $54 million, and it's such a large amount compared to its previous years. Realty Income Corp has a very strong balance sheet, despite the fact that I would say that its current price is a little bit high. However, what is the future scope of this company? I recently read that they recently decided to acquire 12 properties located in the UK for around 429 million euros with Sainsbury's, which I guess is a leading grocery store in the UK. And I feel like this is a very positive step for Realty Income Corp, because they are showing that they are starting to now diversify their single tenant properties on an international basis. And of course, we cannot neglect the fact that COVID leads to uncertainty within the real estate marketplace. But like I said before many times, I feel like this company has a very excellent balance sheet to keep them afloat. And I feel like things will start to become a little bit more of a struggle in the next coming weeks and months, because it is estimated the PPP loan, or the Paycheck Protection Program within the United States, will eventually quote unquote run out. No one will have that extra cash flow on hand from the PPP loan, which makes it essentially harder to pay rent. So we'll see what happens in terms of the next coming weeks and also the next coming months in terms of the real estate space, and we'll see how that affects Realty Income Corp in that same time frame. Now, before we end off, I wanted to come back to this screen right here, because in the beginning I did state that Realty Income Corp has a very high PE at 40.27, which is something, as personally a value investor, I wouldn't really buy or really look at into a company that has that high of a PE, because that means it's a little bit overvalued in this current time. However, the reason I decided to buy this company is, like I said, is for the purposes of its dividend. Now, ultimately, what made me decide to buy this company at this current price, despite the fact that it could be overvalued, is because of its monthly dividend. And I feel like as long as I have those dividends reinvested, it will lower my cost basis no matter what, even if the price continues to drop. However, if the price continues to rise, those dividends will still be reinvested and continue to at least even out and average out my cost basis. And it is in a similar vein to dollar cost averaging. So that is the main reason I decided to buy Realty Income Corp at this price, because I can't predict the future. So despite the fact that it is high now, I don't know whether or not it will go lower in the near future. So I might as well invest in it now, collect the dividends, and that maybe will help lower my cost basis as the time goes on. And honestly, that about wraps it up. That is a quick breakdown, well, maybe quick, maybe not so quick, of 2 dividend stocks that I decided to recently buy in the past 2 weeks for my Roth IRA. To take advantage of the fact that I will not be getting taxed on these 2 dividends, but I will be able to grow my portfolio exponentially and compoundly in the meantime. So give these companies a look if you haven't already. And that about wraps it up. Thank you guys so much for watching, and I'll see you guys next time. Peace.